very optimistic. Kind of going stir crazy. I'm in the same 3 rooms of the house, but
yeah, I know that feeling.
But no, I'm going up and down stairs 10, 12 times a day, so it's good.
Wow, you're being aggressive.
Yeah. I do what my body says I can do.
Yeah, understood.
Because I do not want a setback. I've seen this movie, so.
I was a cancer survivor, and I remember that first day after being in a hospital bed for over a month. When they said you've got to walk the hallways, and it was just so scary to do it.
Yeah. Well, especially I'll just speak for me. I weigh 200 and some odd pounds, and they bring these 2 waifs in to walk me around, and I said, if I topple over, this is going to be like bowling. I'm going to take everybody out. I mean, I weighed more than the 2 of them combined, and it was that scared me more than anything.
I hear you. So what's working this morning, Kevin? Have you had a broad view of the market at all? Anything catching your eye in terms of thematics?
What I'm going to talk about is frankly, it's what seems to me is, especially our own people are saying the Apple earnings or worse, and the stock goes up. Tesla earnings horrible, the stock goes up. Nvidia hasn't announced, but that's taken on water like a torpedo. Microsoft earnings were poor and taking on water, and it's just like we're trying to levitate this market. I didn't see any earnings calls this morning that kind of caught my attention, but there's 4 of the big ones right there, and it feels tired. And we're 1% away from highs, but it doesn't feel like it. It feels like we're trying to prop up Apple and Tesla to keep the game going, and it just we'll see how we close at the end of the day. I think we ended towards the end of towards the lows. I always discount the first hour, as I mentioned on the last show, and pay way more attention to the last hour. But that's what I'm seeing right now.
Yeah, Ben and I were just talking about how this, Apple was rallying on what we thought was pretty bad news. But and then if you watched intraday some of the action, so when tariffs were mentioned, the stock market would tank for all of 30 seconds, and then they bring it right back. It was almost as if somebody wanted to train the market not to worry about tariffs. To view that any comments on tariffs as a buying opportunity, so that Trump could use that as a weapon without negative consequences domestically. And it's been weird trading, really very weird trading.
Yeah, I don't want to play the tariff drinking game because I'll be crushed. Because I'm sick of hearing about it. Frankly, I just kind of go, wake me up when September ends.
Yeah. Well, but I agree with you that it feels tired. The rotation.
But take a look at this right now. This is Apple, okay? And this is the kind of action that happens. They have the call. They try to talk about how AI is going to be good for them. It opens up at this high, and here we are trading at the low, 40 minutes into the trading session. And my guess is we finish in the red. I don't know that, but this is the kind of action we're seeing in so many of these names. It's just tired, and I always kind of say when if earnings aren't going to move your stock up, what is?
Right.
And especially with Apple, you got 90 days in the desert. I kind of go outside of indexing. Why would you own Apple? Unless you have to hug the index. Why would you own it at 35 times?
And that's going to be my question to you when we get around to talking about the banks is, they've had a phenomenal run here in January. There's probably, I could say fair value is maybe 5% higher without.
Good to go, Ben?
Yep. Ready to go, Ben?
Yeah, we can go. All right. Good morning. Wall Street beats. Can't believe it's still January. It feels like it's been the end of the first quarter, not the end of the first month. We got Kevin Bakes Baker, and Charlie Peabody today. We're going to talk about what seems like not only a long month, but a long week. And what a turnaround, huh, Charlie? Since Monday when the market had a
Yeah.
little crash, and just buy them no matter what their earnings are, right?
It's funny because yesterday you and I were talking about it. Every time tariffs were brought up, the market would tank for 30 seconds, and then someone would come in and march it right back up. And it was almost as if they were orchestrating, or training the market to think of tariffs as a non-threat to domestically, so that Trump could use it as a weapon internationally. Anyway, it's the trading has been pretty bizarre. I think the fact that Apple is up, today is just doesn't make sense.
How is Apple up? How is Apple up? It's the dumbest thing. It's the dumbest stock ever. It missed on free cash flow. Their iPhone units are obviously mega down. They're down in notional dollars for iPhones. China misses. I mean, it's just, and it hasn't grown revenue in 3 years. Trades at 10 times sales. I mean, who's like, oh yeah, so I got to own. It's just, it's very frustrating to be a fundamental oriented guy and like have something like that just rubbed in your face constantly.
Yeah, I don't think fundamentals are driving things right now. That's why we have Kevin on. Bakes is going to tell us why things are doing what they're doing.
No pressure. No pressure.
But anyway, do you want me to get started on a few things here, Ben? I'm gonna. So let me start with what came out yesterday on pending home sales. Jen, if you can put that first chart up. So this is the pending home sales index, and you can see it's just depressed at multi-decade lows. The index came in at 74.2 for December, which was a big drop from November. And there had been 4 months in a row of improvement, and people were hoping that was a sign of better things ahead. So this was a big disappointment. And affordability continues to be the major problem behind the inability to get existing homes sold. And keep in mind that pending home sales are contracts signed but not yet closed, so it sort of leads existing home sales by 1 to 2 months. So we can be pretty assured that existing home sales, when they come out in February, are going to start the year off on a weak note. So housing is just not showing any momentum at this point. And to that end, yesterday, Whirlpool announced earnings and had their conference call. And Jen, if you can put up that quote from Whirlpool's conference call. This is a company that, sells home-related goods, JennAir, KitchenAid, think products like that. And they've been, marching right along all through, the October quarter with, pretty good trends. And then all of a sudden yesterday, they disappointed with their fourth quarter and their guidance. Here's another indication. I'll just read this. As we look into, this is Whirlpool quote, as we look into 2025, we do not anticipate a sudden improvement of what has been a very challenging macro environment, in particular in the U.S. We are highly optimistic about mid and long-term prospects of the U.S. housing market, but at the same time, realistic about the pace of recovery and expect only a slow and gradual improvement in 2025. That latter statement, only a slow and gradual improvement, that's what the optimists are still saying about the housing market, that there's still going to be, low to mid-single digit home sales. And I think we're going to have another disappointing year unless there's some change in affordability. And as I've mentioned before, there's only 3 ways that affordability can change. You can either lower the home price, you can lower interest rates to make them more affordable, or you can start to use government subsidies. And I think home prices are what's going to continue to have to change. And so existing homes are probably about 25% above the normal affordability trend lines. New home sales are probably only about 10 or 15% about the normal affordability trend lines. But anyway, just out of curiosity, Bakes, Whirlpool, what's that look like to you?
Well, this is the daily, and this is pretty amazing. We talked about this offline, and I said, what got people so excited that they would take this stock from 100 to 133, a 33% move, and then say something so abysmal that they would gap down and reverse all of that on big volume. And so now the only good thing I can say is it didn't take out the 200-day moving average, but I'm damning it with faint praise. And to me, this goes into the penalty box for at least 90 days. And someone at IR should learn how to do this and, get people ready for misses. I don't know how many analysts cover this. I don't know how much goes into the big boxes or any of that. But to me, I'm going through the chart book page by page, and I'm not stopping here. And I also look at, I'm going to go to the longer term. You might just have, maybe the hangover's off, but I mean, we pulled forward a lot during the pandemic. And, do you need another washer and dryer right now? Do you need another Gen Air? I don't know. But this is saying to me, go hunt some other places because this dog isn't.
Yeah. And that's kind of my attitude about the whole housing related market. It's still got a long slog ahead of it. And I don't think we've seen the worst yet. So anyway, skipping to a different topic, this morning we got the PCE data, and it was benign as expected. This is something we highlighted on Monday. That we thought we would have, benign inflation data. I think we came in up 0.3 and 0.2 on core and headline respectively. So, inflation's running at a 2.6 to 2.8 annual rate, depending on, whether you're looking at core or headline numbers. So we're still not down to the 2% level, but we're making progress, I guess is the way Powell put it on Wednesday. And I do think Wednesday's press conference was a dovish pause, which is what we had been anticipating. And while some people interpreted it as hawkish, I think you have to keep in mind that Powell had some constraints around how dovish he could get, because he didn't want to look as if he was kowtowing to President Trump. And so he did emphasize that, the current Fed funds rate is way above R star. And he did emphasize that the Fed currently remains restrictive. So if you read between the lines, he was basically saying the next move is going to be a cut, not a hike. And, a month or so ago at the last FOMC press conference, people came away thinking there was the possibility of a hike. But I think a cut is what's next. And whether it's March, May, or June, I don't think the market's going to care necessarily about the timing. They're just looking at the next move as a cut. And one of the things that could contribute to increasing confidence in a cut is what happens to rental rates. So, Jen, I don't know if you can put on that last chart on rents, but there's a chart that shows the Cleveland Fed's new tenant rent index year-over-year change. That's the white line. And this is just the incremental rent cost, not existing rents. So it's a pure indication of what's happening to rents at the margin. And you can see there's some correlation with the CPI's owner's equivalent rent year over year. And it tends to lead, owner's equivalent rent. So I'm expecting that the OER, which is about 30% of, the weighting in the CPI, is going to continue to come down, and that will take some pressure off of rents. In fact, in this morning's release, if you looked at what was the biggest component of the increase year over year, it was, housing and utilities. I think it was up almost 30% year over year, something like that. So if the rents come down, this OER component of CPI is going to come down, and that's going to give cover for Powell to cut. So I do believe that we're going to see the next move being lower on the Fed funds rate. On Monday, when we previewed some of this, I said there are three ways to play it. My preference would be precious metals. I also like palladium here. Look at PALL. That's a metal that's starting to break out here, and platinum. But on the banking side, which is the area I know the best, there are four names I've been highlighting. Citigroup has been my number one money center pick. That is a self-help story, continues to work. This is a company that is finally executing on their promises. Jane Fraser, who leads that, is the real deal. She is now building credibility with the street and has a runway that shows 3 years of lower operating expenses and higher revenues. And so you're getting positive operating leverage. And then you combine that positive operating leverage with a $20 billion multi-year buyback. I think this is a very powerful story, and I still think we can be looking at $100 stock in 2026. On the regional bank side, my number one pick is M&T Bank, symbol MTB. This is a Warren Buffett type of name, very conservative, slow-growing, but consistent type of bank. Very liquid, strong capital, buying back stock. Margins are expanding there as well. So NII, which is really the big driver there, is doing well. If you want to get into some more controversial names, then there's Citizens Financial. This is a turnaround story. They had a transition year last year, symbol is CFG here. If all goes well, they're going to have double-digit earnings this year, growth this year and next year. But if the macro environment, particularly the rate environment, doesn't cooperate, they could falter. And I think this is a name that I've mentioned in the past. If they do falter, it becomes an acquisition candidate. And we believe that PNC is one of the companies that would like to buy this. I guess there's somebody out there saying this is a dog. But anyway, the last name is Truist.
That's what we should do for all pitches. It's just like if someone doesn't like it, just do the dog. That's a dog.
Yeah. And then the last name is Truist, TFC. This is the merger of BB&T and SunTrust 5 years ago. It had great promise, but management has never been able to execute on their promises. I view this as more of a total return stock. They've got a nice 4.5% yield. So you don't need much beyond that. They are starting to buy back their stock again as well. But they have to show that they can, generate the cost savings that they had promised, and we haven't gotten there yet. So those four names: Citigroup, M&T Bank, MTB, Citizens Financial, CFG, and Truist. I'd love to get your take on those banks if you have it.
Well, it's great that you say that. When I first came on board and I said, okay, Charlie Peabody's here. This is going to be great. We're going to talk about banks all the time. But then we go from palladium to Winnebagos to washing machines. And so all these bonuses keep piling up. And what I'm struck with Citigroup is if you ever meaningfully take out these levels here, I mean, this goes back to the financial crisis. And if you can meaningfully break above this, then you really got something going. I mean, this is going to be beautiful if and when it happens. And I pay attention to this on the down days. And even when the banks are down, Citigroup gets a bid. Look at this up volume here, this blue volume that you see up here. It's just, even when earnings aren't going on, people want to buy this. And I think it's probably for some of the dynamics we talked about. Forever it was the discount to book value story. Well, now it's the, turnaround Mexico spin, get closer to that book value. And again, if you take out, 85 in a meaningful way, I'm just making that number up from squinting, I think it's going to be beautiful. Absolutely. So that's personally my favorite.
Yeah, and just to, from a fundamental point of view, I think fair value this year, assuming things progress slowly but on track, somewhere between 82 and 88 has been, and with 100 plus, for 26. anyways,
I'm just a humble chartist. I just draw horizontal lines and want them beaten. So, but if you're but watch what happens when you see it close above 85, especially if the volume picks up. It's going to be an absolute thing of beauty, because the muscle memory, if you lost money in the financial crisis, you're a long gone city, and it becomes emetic when every time you hear that phrase. And I think it's going to be phenomenal. MTB doesn't entice me as much. I don't like the volume here. City looks like a better staircase to me. Citizens, you can see the banks kind of all look the same, but I'm just struck by the long-term picture of City that draws it to it. And TFC, yeah, I think these all look good, but City would be the leader in the clubhouse with me, mainly because of the portfolio manager bias that you have to work off, and it's 15 years, 16 years, and now it looks like it's finally starting to happen.
Along those lines, Kevin, I think your observations are spot on. The stocks that worked best in January were the money center bank stocks and the capital markets stocks like Goldman and Morgan Stanley. Whereas the regionals, they have an interest rate bet component to them, because their primary revenue component is net interest income or spread income. And, people aren't really willing to make interest rate bets. So I think the regionals will only work if we get these lower rates and a steepening yield curve. And on that front, I'd love to hear Ben's thoughts about where we're headed on the rate structures, because he's our guru when it comes to rates.
Well, I am willing to make interest rate bets. That's my favorite thing to do. You just buy the D-SOFR futures. It's like 96.11, 96.12, and just don't think about it. Rates are going lower. There's no. That's it. You don't overthink it. Like, everyone wants to overthink it. Rates are going lower. The mortgage market's dead. The housing market's dead. You know what they need? Lower rates. Eventually, the stronger dollar will filter through. And let's be honest, Trump, they're giving me the dog. They're saying, no, rates are going higher. That's what the dog's telling me. I'm getting rejected by the dog. But look, gold's at all-time high, probably because of what I'm saying, right? So you own gold because they're going to take rates lower. And so, no one believes that they can actually say, hey, we're going to cut this dog of a deficit down, right? Like, they're doing a little here and there. But, like, people probably don't realize that if we go back to 2 or 3% deficit, the sharpness of what's going to happen is going to make 2022 look like it's going to be 2022 all over again, but maybe sharper, right? And because I could argue that in 2022 the economy was in a lot better shape, right? So we just had a rates/fiscal correction that was offsetting a strong economy, and we had a growth in the immigration. Well, now we got none of that. If we're going to take the deficit down, and we're going to kick people out, and we're going to have assets not trading on fundamentals, and it's going to take lower rates to keep this dog going. That's the only lever to keep this market from imploding at some point here. And so I think the easier way than shorting stocks is to own gold and own the DEES 2006 3-month futures and SOFR. That's my view. Kevin, what else you got for us, buddy?
Yeah, but I want to point out to Charlie, and I want Jen to record this and put this into the archives. This is 83.11. This is the high through this whole period from the Great Financial Crisis, 08 up until now. That's 17 years. Okay, if you see, and I know that's a false precision, but watch what happens and watch my words. Mark my words. If you see a close above 83.11 on 20 million shares, let's say, this thing is going to take off, and you're going to see 100 really, really fast and more, because you've got all this white space up here to fill in. And 83.11, that's the number.
Can I push back on that? Like their share structure is massively different. I don't think it's fair to like compare that because like let's look at their market cap chart, right? Like their market cap chart versus their price chart are totally different things because they just issued a shitload of stocks. Sorry, my French, but they issued a ton of equity and debased the equity. So like I don't know if you can really compare the stock price pre GFC to post GFC. I don't really understand why that's comparable.
Their market cap.
I'm just telling you, the market has a memory, and if this closes above 83.11 and this 82.90 level, and I don't care what the S1 says, this is going higher, in my opinion. Yeah.
I'm not saying that. I'm not pushing back on that. Charlie said a great call. I'm just saying
that's what we do. We try to make money.
Yeah, that's all we're up to, making money.
Their
market cap is still puny relative to. I mean, Nvidia trades, in one day, what Citi's entire market cap is. So it's not going to take much of reallocation, and you still have a lot of doubters because of the history of Citi. I can understand why you have doubters. So many people got burned over the last 10 or 15 years. So there's a lot of.
It's been a terrible bank. It's been the worst of all the major banks by far. I was a Citi client for a long time, and now
let's do stock market and portfolio management jujitsu and use that for us versus against us. If that's the bias and the bias gets reversed with a close above 83.11, then you get a lot of people that are saying, "Wait a minute, the financials are what 17% of the S&P. I'm making that number up. I'm going to be close, and Citi is 3, and get me some Citi." And the PM pulls the analyst in and says, "Get to work. I want to be overweight Citi because it's acting better than hugging J.P. Morgan, which I've been doing for the last 17 years."
Yeah, and Citi, I think, has been the number one best performing stock so far in January. It has been. Citi's up about 16%, and there's no large cap bank stock in January that's been up as much as that. So, and last year was in the top, 5, I think, top 4 in terms of best performance. So, portfolio managers are going to have to take note of this if they want to, play the relative game.
83.11.
Would you do it like if you were to say, "Hey, I'm going to go market neutral on banks and run like a levered book"? How would you structure that? Like maybe as a something for people. Like if I say, "Hey, have 5 positions, 10 positions," like what percentage of that book would Citi be? 20?
You're asking me or Kevin? Sorry. You're asking me. Yeah, sorry. Yeah, it would definitely be an overweight position for me. So, I guess that depends on the individual risk tolerance. As I said, I think the banks probably, their fair value from here is up another 5%. But if we get tax cuts or visible signs that deregulation in the banking industry is going to happen, then we've got another 15% upside this year. But I think the run in January is something that you want to be careful about chasing too aggressively right now. And the reason I say that is, the fundamentals are very positive. We all recognize that. Margins are expanding. Net interest income is inflected positively. Credit costs are benign. Expenses are well disciplined. Capital markets are robust. But if we don't get this rate, improvement, Ben, that you are anticipating, then there's some headwinds to all of the fundamentals we know today. And then you have to throw on top of that what's going to happen with tax policy. And then finally, what's going to happen on the regulatory front. At this point, we do not have a permanent head of an agency other than the Fed. Powell's the only chairman of the Federal Reserve. Right now in the FDIC, we have an acting head in Travis Hill. At the OCC, we have an acting head in Sue. And Rohit Chopra has also resigned at the CFPB. And what's interesting to me is that Trump has not made it a priority. He's done a lot in the first week and a half or 2 weeks of his presidency, but he has not made it a priority to replace the heads of these financial agencies. And you would have thought the very first thing he would have done when he came into office is to replace Rohit Chopra at the CFPB, and he hasn't even done that. So maybe deregulation of the financial services industry is not a high priority for him at this point. I think we're going to get there, but we have to sequence the timing of these things, and that's important. And he hasn't shown at the moment. And in fact, he's gone out of his way to criticize both Bank of America and J.P. Morgan for not banking conservatives. So maybe that deregulatory theme is a later process. And you, Ben, you and I listened to French Hill on a podcast, that we hosted
Zoom.
at Portal Partners, Zoom call. He said you got to be careful about where you spend your political capital. He kind of implied that financial services wasn't a priority. If they have to spend political capital, financial services wasn't a priority.
Right.
When you look at, sorry, go ahead.
No, I was just going to say that was my point of asking you this, is because now if you're talking about banks, I'm taking a lot of beta to banks, which is a lot of hope of deregulation, which again violates the number one rule of investing, which is never short engineers and never long politicians, right? And and basically you just like Fannie Mae, right? Like everyone who's listened to our show knows I was pitching Geo and Fannie Mae all year last year, $2, $3, $4, $10 to $12 for Geo. Then I'm out of there. I don't want to be cheering for deportations or cheering for these guys to disappoint me again for the third time in a decade. Like, you just don't want to be long politicians as a rule as an investor, okay? And basically, when I think about the banks, I think that you need to be long politicians here. And so that's why I asked you if I'm going to go market neutral. So I'm going to short some banks, I'm going to long some banks, and I keep my beta to the banks neutral. Like, then you can pick the better banks. Like, Citi's been great. Goldman's been good. Like, some of these mid-cap banks have been, they had their rally after SVB. So I just think about that is like, can you just choose amongst the banks the relative outperformers and not have to be so subjected to the beta that is, what is Trump and these guys going to do with deregulation of financial services? That was kind of where I was coming from on that.
Yeah. And the way the market is voting right now is money centers, the J.P. Morgans, the Wells Fargos, the Citis, and then the capital markets, the Goldman Sachs and the Morgan Stanleys. That's the way the market has been voting. Those are the names you want to ride. Regionals really have continued to lag, and so we'll see if some of these regionals can turn around if we get the right interest rate backdrop. The big thing that everyone also is betting on is this huge excess capital that's been building up in anticipation of Basel III being implemented, and now it looks like Basel III is dead. And so the biggest banks, which were going to be the most impacted by Basel III, have a lot of excess capital. The question is, do you want to use that excess capital to buy your stock back at 3 times book if you're J.P. Morgan? It's destructive.
Exactly. That's kind of what I'm saying. Is this just buying banks during the spring of 2023 was a great time to buy banks, right? There was blood on the street. Everyone would tell you, "Oh, banks it's GFC again." Well, now there's a lot of hope in banks and a lot of excitement about banks. And that's why I worry that you might be disappointed with you have potential to be disappointed, because just what you said with French Hill, you only have so many chips to play, and where are you going to play those chips essentially? And that's, unless you're in those conversations, it's tough. It's a tricky bet.
Yeah. Bakes, I don't know if you can do this on the fly looking at JP Morgan's chart, JPM. As you mentioned, everybody's hugging that. The indexers are hugging that because it has been literally the best managed, best franchise, best earnings momentum. They continue to execute on all their promises. And that's the lead steer. If that one were ever to show any kind of weakness, then I think everybody else is going to start to, fall under the weight of JP Morgan. So what's your technicals on the JPM chart?
Well, this is why I get paid the big bucks, Charlie, because this chart's been up there for the last, 2 minutes. Well, you've been.
I'm looking to be in your
during your soliloquy. Anyway, but this is what, and I drew and I love this because I don't, I'm not going to go back and look at J.P. Morgan GFC for other than we have this conversation. But look at the difference. This is 2009, the great financial crisis. Obviously they got shellacked like everybody else, but it's a 5-bagger from then. and people genuflect to Jamie Dimon, and because he doesn't blow you up. And he under promises and over delivers, and he's always dour. But this is just a home run. But what's the multiple? 2.7 times book, something like that. I'm making that number up, but I'm going to be close. See, I do fundamental work too, guys. I'm not just a pretty face chartist. But this is the kind of thing where you can really, make money and outperform. Because if you went through, Charlie, the PMs that you used to walk in on, I'll guarantee you, J.P. Morgan is overweight and Citi is underweight in almost every case. And when you get that shift happening, where people have to say, I've got to own something else, and then it's a very logical conversation to have with the Philadelphia pipe fitters. Hey, that was overvalued. We played that well. This is undervalued. In the case of Citi, we're going to play this discount to book value. Charlie says fair value is 88. Bake says don't sell it too soon, and you're going to get triple digits, in my opinion. And we're off to the races. But there's nothing wrong with J.P. Morgan. It's like mom and apple pie and IBM in the old days, and frankly now. You don't get fired for buying IBM, but the resilience off the financial crisis versus Citi is stark.
Yeah, your comment about you don't get fired for buying IBM or JP Morgan. I hear that a lot. Analysts do think about career, suicide, and
absolutely,
Citi has been career suicide. So,
I mean, honestly, you don't get fired for buying IBM lately because it's dominating.
Yeah.
If you pull up, I'll send it to the group chat, but the chart of IBM divided by NVIDIA is an amazing pair of trades since last June. Just
look
a
at
complete domination by old Big Blue. You know what I mean? NVIDIA's the new tech. Look at him, IBM making a comeback, baby.
All-time high.
Look at that. Look at that stock. Look at that stock.
So
you guys go buy your exciting OpenAI, doesn't make money, will end up being a terrible investment. Buy an IBM, Big Blue, baby.
Yeah. So thanks. You mentioned the depth of knowledge that people like Ben Brey on this podcast or this platform have. For kicks and giggles, or put up PALL, Palladium. So we know that gold and silver are breaking out.
I don't know about that. We'll talk about that, but okay.
Okay. All right. So,
gold's at the all-time high. What are we talking about? Of course, it's breaking out. It's
I like the miners more than the metal, but that's not working.
Hold on. I gotta stop you. Anyone who's listening, don't listen to him. Let's just pull up a chart of GLD versus GDX over the last 25 years. No, gold miners are a joke. They're just big liars next to a hole in the ground. Buy gold, actual gold, and don't listen to people who are selling you gold miners. I'm sorry, Bakes. Gold miners are not a thing you want to invest in.
No,
I'm a very staunch believer in this.
I'm in the and business, not the or business. So I don't. Why not own both?
I'm telling you that look over time, and they do not perform. They're garbage businesses. Own gold.
Hey,
if you want to own gold beta, just own gold.
Ben, I bet you AEM has outperformed gold. Agnico Eagle. That's and Alamos Gold, AGI, and AU Anglo Ashanti. Those three I really like.
I think I left my Bloomberg terminal sign-in out there, but I will get back to you on that. And I will send it to our chat and maybe even tweet it out, like the absolute ass-whooping that GLD has put on GDX over the last 25 years. It hasn't even been close.
No one's going to own anything for 25 years, by the way. No one owns anything for 25 years.
True. That's not true. I talked to somebody yesterday who's owned Apple and never sold it since 2000. Just held the entire time.
I talked to Elvis the other day. I mean, that's about how rare they are. So,
you know what? That's actually a good point. It's a good point. Trading is actually not a great thing, because the reality is, if I bought Bitcoin for $100 the first time I ever bought it. I'm not worth nearly as much as I should be, because you try to trade it. Apple, I was one of the first people to buy an iPod when it came out with a silver backing. I knew it was great, and then you trade it. Sometimes you just hold when you got a really good winner. I have held gold since 2003, and that's done quite well. So like the reality is that trading can be great, but holding can be great too. So let's just not talk about gold miners. They suck.
Well, then let Bakes talk about palladium.
It looks like it wants to rear its ugly head. I want to see this be more definitive. I want to see the moving averages going up. I do like the fact that the volume is perking up. I love precious metals from time to time. I'm just not convinced this trend has changed yet, especially given this reversal that we saw here. So I want to see this above 95.39. This is Paul, physical palladium, the metal, not the miners, not the holes with liars on top, but 95.39, which is not that far away, and I want to see this volume follow through. But I'm interested. And by the way, to our members and prospective members, anytime we talk about anything on this show, I put it in my system and I look at Paul and GLD and all these things every single day, just in case I miss something. So I'm going through this every day so that nothing falls through the cracks.
We appreciate it.
Nice. All right, Banks. Well, we appreciate that. Anything else you guys got today?
No, I do. I'll be brief. And I'm just struck by we're about 1% away from all-time highs in the S&P 500. This is SPY. It doesn't feel like it, does it? We get on our live chat, and it's Apple earnings sting, free cash flow miss. Meta doesn't buy back stock. Tesla numbers stink on delivery. Bitcoin makes up the earnings gap, but the damn stocks go up. And it just feels tired to me. And we're starting to see those three names I just mentioned try to make up for NVIDIA. And I'll guarantee you that some of these folks that went from 153 down to 120 or so, they picked up some IBM, because they can read a chart too, and they can listen to a conference call. So NVIDIA is taking a torpedo. I don't know if it's going to go through through all the hulls, but it's a problem. And we talked about this the other day, so I'm not going to go through it here. But NVIDIA, if I own this outright, I would sell a third of it. I would have sold a third of it and stay here, and I'll let you know when the other 2/3 of my sell discipline kick in. Microsoft, I haven't liked it in a long time. So there's 2 of the 7. Look at this. This is a dog with fleas, and you can argue. And now
get that dog going.
Yeah, who let the dogs out? What happens is the chart says, okay, there's some warning signs. What are they? And then all of a sudden, DeepSeek, is released on December 25th, or their paper was, or both. I forget which. And now all of a sudden we're saying, all right, Nadella is not the master of the universe. He's squandered billions of dollars. OpenAI looks like they're on their heels, and Microsoft is not going to be gathering what Google spills, or what DeepSeek spills, it looks like. So, and look at the volume down here, okay? So bottom line is, the market feels heavy, and I think you're seeing some of these ugly earnings reports getting rewarded, because people saying it's the worst, the best house in a neighborhood on fire. That's too strong, but you get the idea. The market's heavy. We're seeing rotation, and one by one, they're taking out some of the darlings, and that's what I have.
Yeah, I just think that you're totally right, and it's tough. The one thing I think I would add to people is so gold's at all-time high, and S&P's at all-time high. So one of the things I did last week and the week before was I got a little early shorting the S&P. And then I was like, all right, this is annoying. I knew I was a little early. So I bought gold independent of my view on gold for the long term. But the correlation on gold and S&P is very high. So I bought that as a hedge in essence, and they were moving together. And then on Monday, you had a break when you had the DeepSeek thing, and I covered a lot of the S&P short, kind of got bailed out, if you will. And because, again, we're back at the levels we were like last Thursday and Friday, right? Before, it's like DeepSeek didn't happen. But I think that tells you a little bit that there's a denominator issue going on, because it doesn't feel great. I agree that things are going up without fundamentals. And so I think you're worrying about the unit of account here and some of the prices. Or it's just the bubble, and just people are buying U.S. assets in droves and not buying foreign assets. And this is what happened in the late 90s and 2000. So one way or another, it's very difficult to be a fundamental guy. That's why we love the Bakes. He's in here just saying, hey, I don't care what the fundamentals are. This is what the chart's telling me. So it's wonderful to have a guy like that around who's not saddled with the fundamental narrative, what the terminal value and the perceived terminal value is and all that stuff. But I think I agree that the market feels tired. I think NVIDIA's done, and I wrote that up as a short last June. Stock's still down since last June, 7 months ago, dramatically underperforming, especially versus IBM. And we're basically now having Microsoft looking top it out. Tesla had a great run. We don't really know if that was just because, him and Trump are buddies. We don't really know what that was, but their numbers aren't good. Meta seems to be doing well. Google is okay, doing well. I mean, so they're fine. These businesses are fine, but they're not accelerating, right, Kevin? Is that what you're saying? They're just kind of like, and when you have a stock so far in front of its skis, you need it to keep accelerating. Fundamental delta, I guess, is what I'm saying.
Yeah, well, earnings report or after earnings report, people were saying no one said that they beat on every metric or they beat on every line, and it's not that bad. And like even Meta, okay, everything's great. CapEx is going to come down a touch. They imply that. I don't think they said that explicitly, but but they're not going to buy back stock. There was always a yeah, but. And again, I think that your people are saying, oh, I'm going to fade NVIDIA and Microsoft. I'm going to top off Meta, and we'll see how this goes, because they look smarter on the AA front than maybe they did earlier. Apple, the same thing. But just take a look at Apple here right now, okay? Apple had the call, and if you want to talk about people with pom-poms out, it's Apple, all right? And it opens up, and here we are trading at the low of the day on actually okay volume. We'll see how this goes. I bet you this ends up in the red. Whenever you have the emotional first hour, pop the stock, and then it fades for the rest of the day, which obviously isn't over. I bet you Apple ends in the red and takes on some more water. That's my guess. That's only a day. Who cares? But
I care, because I own the 230 puts, so I would love for that thing to go down $10. Those are zeros right now. So
and that's one of the great things. I don't know yet. I don't know your entire book. I call them like I see them. When the fundamentals and the technicals dovetail, that's when I've found I made the most money, is when the fundamentals and the technicals work together. And I hope I'm helpful.
Well, I totally agree. I'm just saying I have puts that expire at 4 p.m. today that are $10 below. And literally when I saw the print, I was like, great, they missed. Free cash flow is garbage. And then they just have $100 million buy candle that keeps it up there for what reason, I don't know. And now the market's open and it's fading again. It just feels very manipulated and garbage to me. And anyway, I'm going to leave it at that. Don't get me started on Apple. I think we got to call it. We've been almost an hour here. I think we just lost Charlie. That's it for today. Thank you, Kevin. Thank you, Charlie. Wall Street Beats, come check us out. We'll probably be chatting about this stuff in our own chat, and we're a very lively group. So come hang out with us, and we'll see you soon. Later.
Keep smiling. Thanks.
Thanks, Jen. Thanks, Ben. Thanks, Jen.
Thank you, Jen.
That was a fun Friday show. We kept a little loose there, boys.